Hi, welcome back. Now listen, anybody can look at a chart and see a pattern, but what are you going to do about it, right? Sure, you know you're supposed to sell short if you see a double top or a head and shoulders, but where, right? Where are you going to buy on an ascending triangle? What's your buy price? How do you know? Where are you going to put the stop? Where are your targets going to go? You have to be able to answer these questions, right? If not, you're just trading without a plan and you're just trading on whim, and that's not good enough. Okay, so we're going to get involved here with actually planning out trades. And I want you to know, right, some key points here. I tend to color code everything. So when you see green, right, if you see a green line appear on the chart, that represents the entry. Red represents the stop, and blue represents the target or targets. There are often multiple targets on these trades. And so when using multiple targets, we take a partial profit and we tighten the stop if the target is hit. Why did I start using multiple targets is a question that I sometimes get. And when I started out trading, I had no problem at all cutting losses. I was very good at cutting losses, but I seemed to be having trouble holding on to my winners. You've got a position, it's a full-size position, it's going up, it's making money, and it starts to burn a hole in your pocket. You want to ring that register because it feels good. The problem is most of us ring that register too soon because we don't have a plan for getting out, and we just get out when it feels like it's time to get out. That's not a plan, and what you're going to find is a lot of the time you're going to get out too soon, you're going to leave a lot of money on the table. You know, people love to say, you can never go broke taking a profit. That's not really true. You can leave a lot of money on the table by taking profits too soon. And by using multiple targets, that's one tactic for staying in the trade longer than you might have otherwise. The position size is now half as much, so it only bothers you half as much. And you've got some money in your pocket already if you've already hit the first target. So it makes it much easier to stay in the trade. It's really a psychological thing to keep you in there when it's going correctly. Of course, when it goes against you, we only have one stop. When that stop is hit, the trade's over. We start again. Now, what about this head and shoulders pattern? How do we trade it? First, we have to determine, of course, if there is a trend to be reversed. Then we measure the shape, the pattern itself, the head and shoulders, from the neckline to the top of the pattern. So for example, if the peak of the head is, say, 132 and the neckline is 128, then we have a difference of 4. It measures 4 from the neckline to the peak. Now, very simple. I'm going to give you a little template here. What's 10% of $4? 40 cents, right? Go to that neckline. Put your entry 40 cents underneath the neckline and put your stop 40 cents above the neckline. And what this does, by putting your entry below the neckline, we want the price to break support, and when it breaks support by a sufficient amount, that's when we're going to sell short. So for example, in the following chart, the entry point to sell short is 127.60, the green line. Why do we have it at that point? Because the neckline is 128, the peak is 132, that's $4 from top to bottom. 10% of $4 is 40 cents. Our entry, that green line, is 40 cents underneath support. Now, as I mentioned earlier, we're also going to place the stop. The entry is 40 cents below the neckline. The stop is going to be 40 cents above the neckline. Again, the pattern measures $4 from top to bottom. 10% of $4 is 40 cents. The stop goes 40 cents above the neckline at 128.40, which you see here in red. Now, when it comes to setting targets, again, we refer to that height of the pattern. If the pattern has a height of $4, the first target is half of that amount. The first target is $2 as measured from the neckline. So, neckline is 128 minus $2. Target 1 is 126. If the price reaches 126, we'll close half the trade and we'll move the stop down to the entry point on the remaining portion of the trade. The entry point, of course, 127.60. What about the second target? We're going to have two targets here. The second target is equal to the height of the pattern. So, if the pattern measures $4 from peak to the neckline, then you go from the neckline, measure down another $4. That's your second target, 124. And again, the entry is in green, the stop is in red, the two targets are in blue. That's how I'm color coding everything in this course. So again, if you have a height of $4, 10% of that amount is 40 cents. The entry goes 40 cents below the neckline. The stop goes 40 cents above the neckline. How do we determine the targets? If the pattern has a height of $4, half of that amount, $2, is the first target, not measured from the entry, measured from the neckline. Neckline's 128, that means the first target. 128 minus 2 is 126. The second target is equal to the full height of the pattern. $4 height of the pattern, subtract $4 from the neckline of 128, and you have a second target of 124. And here's how it looks in the order entry system. We have a short entry with two limits because we have two targets, right? Those are limit orders. And one stop because if the price goes up and hits that red line, it hits the stop, we're out. And of course we're selling short because it is a bearish head and shoulders pattern. Here's how the order appears in the system. In this case, we're selling short 1,000 shares at 127.60. You'll notice that there are two separate stop orders at a 128.40, each for 500 shares, which of course you add 500 and 500, that's 1,000 shares. Why are there two separate 500 share orders for stops at 128.40? Because there are two separate targets, and as you can see, this trade is divided into two 500 share chunks for the stop and the target. The difference is this. Both 500 share stops are at 128.40, so essentially there's just one stop. If you hit 128.40, you're going to be out of all 1,000 shares at a loss, 80 cents per share. However, if the first target is achieved, this is automatically going to take you out of half the trade. At the same time, it's going to eliminate that 500 share stop on half the trade. Why is that important? Because once you close half the trade, you're only short 500 shares. You don't want to have a stop for 1,000 shares at this point. You want to have a stop for 500 shares. And if you're using OCO, OSO orders, and there's one cancels other orders, that's going to take care of this automatically. That's what I'm doing right here. I'm showing you exactly how to set it up in the system. Now, the only thing we have left to do if we've hit the first target is move the stop to break even. All right? And again, the OCO system is going to reduce the position size automatically. All right, so let's move on to the double top. Here we have a pattern with a height of $5. 10% of that is 50 cents. The support level on the double top is 143. Therefore, the entry is 50 cents, or 10% of $5, underneath the support of 143. Therefore, the entry is 142.50. The stop will be 50 cents above the support level of 143. That means our stop is going to go at 143.50. So we're risking $1 per share on this trade. And again, the entry is green, the stop is red, and we only need to now concern ourselves with the targets. The height of the pattern is $5. Half of that amount would be $2.50. The first target is $2.50 measured down from support, not from the entry, measured down from support of 143. That means target 1 is 143 minus 250. Target 1 will be $140.50. Target 2 is determined as being equal to the height of the pattern. The height of the pattern is $5. Target 2 is $5 beneath the support level of 143. So 143 minus 5 gives us 138. That's the second target. Okay? So again, entry in green, stop in red, targets in blue. And again, here's how it looks in the order entry system. You're going to use an OCO order with 2 limits and 1 stop. And again, you're going to break the trade up into 2 targets. So if we short 1,000 shares, we're going to need to cover 500 shares at target 1 and 500 shares at target 2. You'll notice the order type for the entry, right? We want to enter the trade at 142.50. That is a stop market entry. Going back to order entry for a moment, on order types. Why? Why is it a stop market? Well, if the price is above 142.50 and you place a limit order, guess what's going to happen? It's going to execute now. Why? Because when you place a limit, you're saying, I want to sell it at 142.50 or higher. What's the problem with that? It hasn't necessarily broken support yet. You don't want to short this until it breaks support. That's why you're entering a stop market order at 142.50. You're saying, stop. I don't want to short this until it breaks support. I don't want a better price. I want my price, 142.50. Because the truth is, if you short it before it breaks support, it might never break support. These patterns are not foolproof. Otherwise, we wouldn't need to use stops. We always have to protect ourselves. Now, as far as managing the trade is concerned, if target 1 is achieved, the system, if it is an OCO system, one cancels other, will automatically close half the trade. We will move our stop to break even and reduce its size by half. Of course, that happens automatically in the OCO. If you're not using OCO, you're going to have to do that manually. Now, both the head and shoulders and the double top patterns are bearish. We simply reverse the strategy when we're trading an inverse head and shoulders. That's a bullish pattern, but it's the same template. You measure that inverted head and shoulders. Your entry is 10% above the neckline. Your stop is 10% below the neckline. Your first target is equal to half the height of the pattern. Your second target is equal to the full height of the pattern as measured from the neckline, not from the entry. Okay? And that covers how to trade a double top. That covers how to trade a head and shoulders. And it also covers how to trade an inverted head and shoulders and a double bottom, which are the bullish versions of those 2 patterns. Now, there are a lot of patterns in technical analysis, but we're only going to focus on the most important ones. The third and final pattern that I want to show to you is going to be the triangle, which of course has a bullish version, the ascending triangle, and a bearish version, the descending triangle. Now, triangles that have a directional bias, ascending and descending, are good to trade if the direction of the triangle agrees with the direction of the trend. So that means, long story short, in an ascending chart, if the chart's moving up, we have an uptrend, then we'll trade ascending triangles. We will not trade a descending triangle in an uptrend. We will not trade an ascending triangle in a downtrend. So we need to match the pattern to the trend. And as far as symmetrical triangles, we're not going to cover symmetrical triangles. That means higher lows and lower highs, because those are non-directional patterns, and quite frankly, they're really not very good. I could certainly stand here and show you, okay, here's a method for trading symmetrical triangles, but you know what? It's like flipping a coin. I don't like it, so we're not going to talk about it. Okay? I only want to talk about things that are going to give you an edge. Here we go, descending triangle within a downtrend. Notice the trend line, which is just showing you the general direction of the trade, and then notice the descending triangle within the downtrend. Okay? That's very important. We need agreement between the pattern and the trend. What are we going to do with that pattern once we find it within the proper trend? Well, a descending triangle, right? In a downtrend, we measure from the widest part of the pattern. This part is a little bit subjective, so I want you to be very careful. Okay? When you're looking at a pattern, determining the widest part of the pattern is more subjective than, say, measuring a head and shoulders or a double top or a double bottom or an inverted head and shoulders. This is more subjective. Because of that, I want you to always err on the side of caution. Okay? If you're not sure what constitutes the widest part of the pattern, go for a little bit more of a narrow area. Don't widen it out forever and make it into this huge thing. Okay? Be conservative with it. Okay? Don't get greedy and say, okay, well, I'm just going to measure it out way from here and expect it to make this huge move, because it doesn't always work that way. Okay? So we measure from the widest part of the pattern, but within reason. Let's put it that way. And within that descending triangle, we measure the height. Now, in this particular case, the height is $4.75, right? The widest part was $134.25, right? That is the upper part of the triangle. The flat part, the support, was $129.50. $134.25 minus $129.50 is $4.75. And 10% of $4.75 is what? 48 cents. Well, really, it's 47.5 cents. We'll round it up to 48. How are we going to create this entry? We take $129.50, which is that support level on the descending triangle. And if it breaks, then we want to sell short. So our entry goes underneath that support level. How far underneath? 48 cents, 10% of the height. That means our entry is $129.02. In other words, $129.50 minus 48 cents. Your entry is $129.02. And at the same time, your stop will go 48 cents above that support level. $129.50 plus 48 gives us $129.98. And now we have our stop and our entry. And the beautiful thing about this type of trading is, if the support level never breaks, then we're not in the trade. You'll notice that was true with all the patterns that we've talked about so far. In each case, we are waiting for the support level or the resistance level to break before we enter the trade by setting ourselves up strategically in this manner. That's very important to understand. Okay? We're trying to do it in a strategic manner. We're not trying to guess, oh, I think it's going to break, and then sell short. No. We're saying, okay, if it breaks, here's where I sell. If it doesn't break, that order will never be executed, and we'll cancel the orders out and we'll move on to a different trade. Now, we have our entry and we have our stop, but we still do not have our target. Again, we measure from the highest part of the triangle within reason to the support level. In this case, $4.75. Half of that amount is $2.37. That's target 1, as measured from support, not measured from the entry. And target 2 is the full amount of the triangle's height. So the height is $4.75. The second target is $4.75 below support. Support's $129.50. Subtract $4.75. The second target is $124.75. So we have our entry, we have our stop, we have our targets, and we know that when the first target is achieved, we'll close half the trade. If you're using OCO like I do, it'll close it automatically. You don't even have to be there. The only thing you have to worry about is moving the stop on the remaining portion of the trade. Now, in this case, sell short is a stop market entry. Again, why? Because the current price is above the entry point, and we want the price to fall into the entry point. Think about it this way, all right? We're trying to sell short, but we want to sell short as it's falling, not as it's rising. Okay, so if we were to place a limit order and the stock was trading at, say, 130, and we placed a limit order at 128, 129.02 to sell short, what's going to happen? It's going to execute prematurely. And we don't want that to happen. We don't want the order to execute unless and until the price breaks support. Now, as with the previous patterns, if the first target is reached, we close half the trade, move the stop to break even. Right? If you're not using OCO, don't forget to reduce the size of the stop to match your remaining position. And break even, of course, is the entry point. So when we do move the stop, we move it to the entry point 129.02. Now, just bear with me one last moment here. Keep in mind, none of these basic strategies, and they were all very basic so far, none of them contained indicators. So does that make them inferior strategies? No. In fact, simplicity is their main advantage. There were many, many successful traders before the invention of the personal computer. And a lot of these traders drew their charts by hand, physically. Can you imagine sitting there and drawing the chart yourself by hand? Okay? Now, there's a place in New York City called the Market Technicians Association. And a lot of those hand-drawn charts line the walls of the Market Technicians Association in New York City, and they look something like this. So it's just something to keep in mind. Long before computers were widely available to the public, there were many, many successful traders. They weren't necessarily using a lot of different indicators or some very fancy backtesting system. They're keeping it simple, and simple can sometimes work better than complicated. And very often, my experience has been that keeping things simple is going to make you more money. Our job is to make money. It doesn't matter if we make it with a complex, complicated strategy or by using something basic. Now, there are many people, look, I call them trading snobs. They feel that trading basic patterns is beneath them. You know, they need to have 15 indicators on the chart. But you got to realize something. A lot of these trading snobs, they don't actually make money. Okay? Many of them are hobbyists who are more focused on the process of trading than the actual result. So in other words, they don't feel fulfilled unless they get to do something that's massively complicated. But complex strategies are not necessarily more profitable than simple strategies. That's a very important point to keep in mind as we move forward.